In this lesson, we'll provide you with a real-life example demonstrating the actual economic value of well-thought-out debt covenants. In 2015, Lowell Group, a financial services provider in the UK, agreed to acquire one of its German competitors. The merger of the two companies produced a combined entity with a risk profile greater than Lowell Group's standalone risk. I'm sure you'll agree that a greater risk profile would have resulted in lower market prices of these bonds. Actually, Lowell's bonds expiring in 2019 were already trading below par since mid-2014. Therefore, investors who wanted to exit their investment before the actual merger would have sustained significant additional losses. However, this wasn't the case in this situation. The merger of the two companies triggered a change of control clause in the bond contract. It gave bondholders the right, not the obligation, to sell back their bonds to the company if a change of control occurs. Change of ownership is the definition of change of control. Therefore, Lowell Group's bondholders could choose whether to sell their bonds back to the company. If they did it, they could sell the bonds at 101% of their face value. This is how the change of control covenant protected bond investors and allowed them a way out. Please look at the chart to see how the bond's price reacted. We can clearly see that the market considered the existence of the debt covenant clause, and the bond's price increased.